If you lead a manufacturing company, then workers' compensation insurance is probably on your mind a lot, as are the costs. Even though rates for workers' comp have fallen over the past 5 years or so across the country, it's still expensive in manufacturing and other industrial class codes, which often begs the question, how do you lower the costs for workers' comp? Hi, I'm Gordon Coyle. Welcome back to my channel, where we talk about the risk and insurance issues on the minds of business owners. Manufacturing executives often tell me that the only way to reduce workers' comp costs is to shop their insurance every few years to force competition to reduce costs. While that may be somewhat true, it ignores the fundamental cost drivers in workers' comp and the underwriting going on behind the scenes. I'm going to pull the curtain back for a moment and give you an insider's view of how the price you pay for workers' comp is arrived at. The biggest factor governing your premium in workers' compensation is your claims history, which impacts your company two ways. The first is through the experience rating modifier, which is a debit credit factor intended to add fairness to the workers' comp system. Employers with above average claims, they get a debit modifier or factor and pay more than their peers with less than expected claims who earn a credit factor or mod. But the second way your claims history impacts the premium you pay is sort of like a gatekeeper function. Every major insurance company has a variety of pricing levels. If your claims history is very low, then you'll have access to the big insurance companies' best rating tiers or levels. If your claim history is so-so, then you're going to be kind of in that middle ground and not get the most competitive pricing tiers. And if your claims are bad, you may not even qualify for some insurance companies, and for those that do offer you a price, it's going to be in their high price rating tiers. The difference between a great pricing tier and a terrible one can be a 50-point spread. When you add in other rating factors, that spread could be as wide as 100 points or more. As an example, let's just take two similar companies with similar payrolls. One has no claims and the other has really poor claim performance. And say they're both insured with the Travelers Insurance Company. The company with great loss history may pay $100,000 and the one with poor loss history may come in at $200,000 or more. This puts this company with poor claims performance at a serious competitive disadvantage. So, where am I going with this? You may be saying, I can't do anything about claims that have already happened, so I'm not going to really worry about it. That may not be necessarily true, but let's just focus on the future. Something I've learned over my 40-year career is that firms with poor claims history are going to continue to have that same poor claims experience into the future until something major happens. And what is that major change? Typically, it's a mindset shift of the owners and leaders of the company to be more safety focused, and in a broad sense, they work towards a company culture that is safety first. It's often called a safety culture, which is a combination of attitudes, values, and perceptions that influence how something is done in the workplace. But leaders that want to shift to a safety culture don't know where to start, or what they should do, or even how to do it. So let me explain it. The first step in making this shift is risk identification. What are the big risks in your company? How are you addressing them now? Do you have the right policies and procedures in place? What are the major trends in your claims history? Then, what controls do you have in place to reduce risk and mitigate the cost of claims after they do occur? How do you communicate and document risk control procedures and processes? How do you implement best practices when it comes to safety and risk reduction? And finally, what reporting tools do you have to monitor your progress? How do you continually improve the safety systems? What early warning or lead indicators are present to help identify and isolate problems before they get worse? It sounds very complicated, but it doesn't need to be. We've worked with a variety of industrial type clients in the past on projects like this, and we're now using an online platform called Smarter Risk to help us through the process and then blend in our experience and expertise to get these projects done. If you're looking to lower your workers' compensation costs, it starts with reducing your claims and improving your safety. This is a long game play. There's no overnight shortcuts, but we can help get this process started and work with you through it. There's no need to recreate the wheel and go it alone. Yep, it's complex and challenging, but on the other side of this process is not only a long-term premium reduction potential, but a safer, more productive workplace. Want to learn more? Reach out and let's connect. My contact info is in the description box below, and I'd welcome your call or email to see how we can help. Thanks for watching.